It's great to see everybody came back. I sometimes wonder how many people I scare away in the first couple weeks, but it's great to see that so many of you are back tonight. And also happy Fastnacht Day, obviously a big day, especially here in central Pennsylvania. I must say that I've had three myself today and a couple of pancakes, two pancakes for dessert tonight. So I think I'm pretty well stocked. So tonight, we're going to talk about something extremely exciting, taxes, of course. And then in a little bit, we're going to bring David Whitenack onto the screen to share important thoughts on plan giving. So as we get set up, and from a tax perspective, of course, there's in terms of tax preparation time, we're getting into the thick of it as we speak right now. And with all that being said, I think this past Friday was the first day you could actually start preparing taxes. And I must say that I did, oops, it's not what I wanted to do there. Let me turn it off. All right, the polka music, I couldn't get rid of the polka music there. So let me get everything squared away here. All right, so yeah, so tax filing, the first time you could start filing your taxes was this past Friday, I believe it was. And I must admit that over the weekend, I went ahead and got mine all taken care of. So it always feels good to have the taxes behind you from that perspective, but lots of time still left. So as we get started with talking about taxes tonight, you see here on the screen two quotes, and by two very famous people. One, Benjamin Franklin, and you can see he wrote there, or he said at one point, "In this world, nothing is certain except death and taxes." And then Einstein, of course, at some point said the hardest thing in the world to understand is the income tax and how that all works out. And hopefully you also notice that both Ben and Albert are masked up in this pandemic environment. So they are wearing their mask properly over their noses. So as we move along, in case you haven't figured out yet in life, the US tax code is one of the most exciting things. And if we look at some statistics that are here on the screen right now, the US tax code in entirety is roughly 75,000 pages and over 10 million words. And so that translates generally to about 40,400 minutes that you would read. So if the average adult, which reads about 250 words a minute, that's going to take 40,400 minutes, which is 673 hours and 28 straight days that it would take you to read the tax code. So again, exciting stuff. I do want to highlight the tax and the legal disclaimer at the bottom of the screen. All of the information contained is general and not to be construed as personal tax or legal advice, just intended to be very broad and large brush of by no means inclusive of everything you should know about taxes. So tax code, very complex. You should always work with a qualified tax professional to determine your best course of action. Nothing contained within this document should be viewed as tax or legal advice. So just wanted to get that out of the way as well. So tonight, again, our agenda, we're going to spend maybe the first 20 or so minutes on these first two topics, which is taxes, including Social Security taxes, how they work, really payroll taxes. Then we're going to spend at least a half an hour hearing from David on planned giving in that area. And then we're going to finish up with some identity theft thoughts before we wrap up and then head into next week, which next week will be the final week of this series as we move forward. So as we go ahead, we're going to start with really a broad overview of the 1040 tax return. So, typically it's something that all of us will lay our eyes on at some point every year, whether we fully understand it or have a grasp of what's really on it. That might be another thing. So tonight, we're not going to go into detail on it, but just sort of highlighting what are some of the things you should at least keep an eye on with your 1040 tax return. So the whole first section here, the first handful of lines, is really lines 1 through 8, focus on income sources. That includes earned income from employment. That includes investment income from your investment portfolio of those components that are taxable there. Also includes passive income. So whether that's rental properties or some other things that maybe are passive investments, things that you're not actively involved with. So one thing I want to note that with lines 4 through 6 here, you'll see IRA distributions, pensions and annuities, and Social Security benefits. So once you're retired, or if you're retired, that's where you're going to see most likely some data and some numbers in there. In 4A, B, and C, that will be the full amount, but 4B, 4B, 5B, and 6B, that's what you can see is labeled as the taxable amount. So not all retirement income is going to be taxable at the federal level. Much of it is, not all of it. But something that David's going to talk about in a little bit, qualified charitable distributions, refer to those as QCDs. Many people in retirement will use that method. That will be all reflected from IRAs and come up as taxable, less the taxable amount. So a couple things there just to be careful of. But again, you got your taxable amount on the right, and some of the other items over here, which some of that might not be fully taxable. So if we move down through, there's some adjustments to income that come further along, which then gets us to adjusted gross income. This is probably a terminology in the tax language that you've heard before, adjusted gross income. And that's really a common metric that a lot of times it's used to determine eligibility for some tax items. Sometimes it's deductions, sometimes it's credits, and some of those type of things. And some of those that maybe are referred to if you're paying student loan interest, that's one. If you're an educator, teacher paying qualified educator expenses, I think they still allow those these days. Deductible IRA or health savings account contributions, things like that, that you can basically adjust and deduct at that point in time. And again, that's coming off, that's some of those adjustments before you get to the AGI, that adjusted gross income. Then everybody can claim either what's called a standard deduction or an itemized deduction. And depending on what that might be, but itemized deductions, and a lot of times those are things that whether it's interest that you're paying for your mortgage, charitable giving, some of those type of things that are itemized deductions that you're probably pretty familiar with. So then at the bottom of the page, we end up with what's referred to as your taxable income figure. So again, everything on this first page, fairly straightforward, and probably you've known most of those things, and hopefully just a good refresher. So if we jump to the second page of the 1040 tax return, here's where the calculated tax will appear, followed by some additional taxes sometimes that can pop up, and also some credits that whether it's child tax credit or some other credits that'll pop up there. And then we get down to the total tax line. Basically, that's your total tax liability that you would pay at that point. From that standpoint, then you can see what's already been withheld from taxes, payments already been made basically along. And then there's some other tax credits that also appear further down the page as well, until you basically get to, okay, here's your total payments of everything that you've paid, including the credits and all those type of things. And then it comes, then it works you through, well, you paid this much and this is what you owe. So do you owe more money when you file your taxes, or you get a refund? So most people, when they file taxes, or more people, get a refund from that one. So the first poll question that we're going to pull up here is the average tax refund for the 2019 tax year, and that's technically the most recent. We're starting to go through the 2020 tax return year right now. But the average tax return or refund for 2019 was which one? So go ahead, and as you've done before, just pick the radio dial and hit submit there, and enter to see what the group thinks. Again, it's a positive number is what it is, and all those numbers are positive. But go ahead and put in what you believe is probably the right answer in terms of this question. So a few people, looks like just finishing up here. Most of you have voted. So the answer here is B, and that's what the most people, 60% of the folks tuning in chose B. That is the right answer. So about 2,500 is that average tax credit, not $37, and certainly not the 74,000. Obviously, that was something that was sort of thrown in there as a joke. But in terms of the average tax refund that the average U.S. taxpayer gets, that is right around that $2,500 mark. So if we move along, next thing we want to talk about is talk about tax brackets and tax rates. So I think one of the important things for everybody to have a grasp on is what is your marginal tax bracket? From my understanding, I think that's a question that a lot of people necessarily don't know what that answer is. But I think, again, it is understandable or something that's important to understand, marginal tax bracket. So what that means, that's really the tax rate that's used for your highest taxable dollar amount. Taxes are in a tiered structure, and you see this. So if we use the married filing jointly column, there's a couple different columns here, but if we go in that middle one, the first almost $20,000 of taxable income is taxed at the 10% tax rate. The next roughly 60-ish, a little over 60,000, again, the gap between 19,901 and 81,000 and change, that's 60, plus $1,000 gap. That next one is taxed at 12%. So again, it's tiered. The first portion is always at 10, and next one's at 12. If you're further along down through there, you keep on stacking it up, and it comes down through there. These are rates for ordinary income. A lot of retirement income, the retirement income that's taxable is generally taxable as ordinary income. Income that you earned income in terms of employment income, that becomes taxable at that same area as well. Some investment income is ordinary income. There's also something called capital gains mostly for investment income. We're going to talk about that here in a moment. But again, the first step is to get a sense of where is your marginal tax bracket. As I've shared before, this is all in the booklet. And again, tonight we're of course behind the taxes and giving tab from there, but this chart's in here, so you should probably take a look at it and get a sense of what is your marginal tax bracket, where does that fall, and of course you can find that on your tax return. The next thing we want to talk about, the next thing that's generally pretty important, is what is your effective tax rate. So your effective tax rate is basically your total tax divided by your total income. And so when we talk about that, there's an example here right on the screen. So really, effective tax rate is the percentage of your total income that's going to federal income taxes from there. So in this example, using joint filers, so married joint filers, in this situation, the total income for this couple is $180,000. The taxable income is $150,000. Remember, there's deductions that whether the standard or itemized. So in this case, used round numbers here using a taxable income figure of $150,000. As mentioned before, that first almost $20,000 is always taxable at 10%. So that math works out pretty easily. The next $61,000 and change is taxable at 12%. And then the remaining $68,000, meaning that to get up to the $150,000 number, that is taxable as 22% bracket, which would be there. So this example, the person is in a 22% marginal tax bracket, right? They have income that bleeds into that 22%. Their total taxes, when we add up the tiers, they're totally paying about $24,500 of taxes. Again, taxable income based on taxable income of $150,000. So to figure out what the effective tax bracket is, and by the way, their effective tax bracket is 13.6%. That's simply taking the total taxes, that almost $25,000, dividing by the $180,000, their total income, not their taxable income, but the total income they have. And that's where you get the effective tax rate. So the effective tax bracket, or rate really is a better word to describe it, is always, of course, going to be lower than what your top dollar or your marginal tax bracket is. So again, good for you to know what is your marginal rate and then what is your effective tax rate. Back to adjusted gross income, we talked about that term before, and sometimes there's a word put in front of it, modified adjusted gross income, and sometimes we call it MAGI, M-A-G-I. Adjusted gross income, an important metric, and there's some tax items, this is not an exhaustive list, but some tax items, there's limitations to some extent. That either will kick in, or you won't be able to take a credit or deduction if you're over. So if we just take a quick example, Roth IRAs. So if you're making a Roth IRA contribution, and if you're a single filer, if you make under $125,000, you can make a Roth IRA contribution. If you make over 140,000, you cannot make a Roth IRA contribution. And if you make between that amount, it's a phased out contribution. You can make a partial contribution. So these are all limits of certain items that, again, whether it's credits, some of these are credits, some of these are deductions and certain things, but that is based on adjusted gross income. All this information, again, is in the booklet. We're not going to spend any more time tonight covering through this, but something to be aware of. Again, you don't need to be an expert in it, but have some awareness for it. The other thing I think that's good to be aware of, there, as of 8-9 years ago, maybe it's been a little bit longer now, there's some additional Medicare, I should say, taxes to be aware of. And as we've talked before, Medicare is the medical system and benefits that are given here in the United States. So as a result of the Affordable Care Act that was passed X number of years ago, there's 2 additional Medicare taxes to be aware of that really hit upper income earners. The first one is based on investment income. So that's a 3.8% tax, an additional tax, if you have investment income that's over 200,000 if filing single, or 250 for joint filers. The other one is based on earned income. That one's a 0.9% tax, almost 1% tax on earned income, again, mostly employment income, with those same limits that were previously up there. So the one thing, it's, again, if you would fall into either of those ranges, there are some additional taxes as a result of the Affordable Care Act that some of you may be also already aware of. None of these limits, the 200 or 250, are indexed for inflation. So this is what it's been each and every year since the Affordable Care Act, and it's a good chance it's not going to change in the future. So as inflation kicks in and more people earn more from that perspective, it's probably these additional taxes are going to catch more people for that. Next thing, also from this sort of, perhaps from the, you didn't know category, is Medicare Part B and Part D premiums. And this is a tiered structure as well. So Part B, when you get into retirement and Medicare Part B, there's a base monthly premium of $148.50 in 2021. Part D depends on what the plan is, but there's a base premium for every type of a plan within Part D. Some people don't know this, a lot of people do, but it depends, there's an additional sort of an adjustment that they refer to if you make over certain limits. And this chart walks through what those limits are. So for, if your modified adjusted gross income for joint filers is over $176,000, you're going to pay more. And each tier you go up, wherever you fall in, you're going to pay more for your Medicare Part B premium. So if you fall into this tier, like the 176 to 222 tier, you pay the 148 base plus the 5940. So, it's 148 plus whatever the number's showing here. Whatever category you fall into, you take that number, you add to the 148, and that is what your Medicare Part B premiums, or Part D, is over here in the right column. So there can be some tax planning to try to stay in a lower tax threshold, so to speak, so that you don't end up paying additional Medicare Part B or Part D premium adjustments. So again, there's certain ways to do that. Qualified charitable distributions, I mentioned that. David's going to talk a little bit more about that. A way to sort of to get away from that. The other item is that we've talked briefly about the standard versus itemized deductions. You're probably all mostly aware of how that works, but here in 2021, if you file as a single, that is your standard deduction to $12,550. If you marry or file married filing jointly, it's $25,100. If you are over age 65, or if you're blind, there's an additional $2,700 on top of these numbers for joint, or $1,700 for single there. So itemized deductions, I already mentioned some of these, of what some of those might, some of the more common ones. But one of the sort of planning opportunities, so to speak, that might be worth, and there's a couple. Donor advised funds is something that those are becoming a little bit more popular as well. I think David might actually be talking about that in a little bit as well. But one way to maybe help from a tax standpoint, with your deductions, whether standard versus itemized, you can consider bunching your deductions into alternate years. So here's a chart and just walking through how that might be. Basically, it's a 2-year, you enter into a 2-year cycle. So let's say if in year 1, if you're claiming that standard deduction, it's 25,100. I was just using a married filing jointly, not over age 65, but under age 65 in this case. So if you choose the standard deduction, in each year, you're going to choose the standard deduction, 25,100 in year 1 and year 2. At the end of year 2, if you add together those, you were able to deduct $50,200. So if you are, if your itemized deductions is a little bit over what the standard deduction is, here's where you might be able to bunch and itemize. So let's say if you're itemizing and your itemized deductions are 30,000. 30,000 is greater than the standard deduction. So generally it makes sense. Let's itemize because you get more of a tax benefit, right? And collectively over the 2 years, you would get 60,000 to be able to itemize rather than the standard deduction of just over 50,000. But if you bunch and itemize, so what happens in year 1, if you bunch those deductions, now this only works if you have the cash flow to do it. And if you are able to prepay some of your year 2 expenses. So what you could do in year 1 is prepay your second year itemized deductions that you're doing. So charitable donations. So you could prepay that second year of charitable donations. You can technically prepay real estate property taxes, home mortgage interest. That gets a little bit more complicated. Definitely chat with an accountant about that before jumping in and doing that. But you can certainly do that. But in theory, if you prepay that second year, and in the first year, you could actually itemize $60,000 because you're basically prepaying year 2 of your itemized deductions. And then in year 2, you're taking the standard deduction of 25,000, and all of a sudden the 2-year total now becomes 85 versus either 60 if you're claiming itemized deductions both years, or 50 if you're doing standard. Normally the math doesn't work out exactly that way, and it's tough to put everything in there. Sometimes charitable deductions you can prepay, but again, mortgage interest and property taxes, while you can do it, it's a little bit more complicated. So while the math, it makes it look like a no-brainer, pretty simple to do, there's some caveats in there and you just want to be careful. But an idea just in case it's helpful to you to explore a little bit further. Moving along here, in terms of investment taxation, there are sort of 2 different methods to go through, and we're not going to jump into details. There are details in the booklet there. But one, when you have investment, there are some items that will be subject to annual taxation. So dividends, interest, mutual fund, capital gain level distributions. So again, this gets complicated. Unfortunately, we don't have a lot of time to talk tonight about it, but on page 140 in your booklet or in the PDF, that will be, again, some information there. This is income that's taxable each year. And then again, some is only taxable at the point of sale, which there's some more examples here that I'm going to jump by as we speak as well. Again, this is annual taxation. All this that's on the screen is also in the book. But then the second component with investments taxation is point of sale. So if I'm holding an investment, and it could be investment property, it could be stocks, bonds, that type of investment. When you sell that, there can be that capital gains tax, and there could be short-term or long-term. Long-term is greater than 1 year. Short-term is 365 days or less. And there's different tax rates for those. For long-term capital gains, there's a preferred lower tax rates. The Medicare, additional Medicare tax, if you're over the 200 or 250 threshold that we talked about a couple pages ago, that would apply. So actually the highest tax rate for capital gains is actually 23.8%. Again, for folks that are subject to that Affordable Care Act surcharge. But generally, capital gain rates are more favorable than ordinary income rates. So a lot more information in the book about that. So a couple best practices here as we get closer to sort of wrapping up this part of the conversation is, there's really 2 important, I would say, best practices to make sure. And one is with tax withholding. If you end a year or if you come when you're filing your taxes and you realize, wow, I'm getting a big refund. while it feels nice to get a big refund, it's also money that you're basically loaning to Uncle Sam over the course of the year, and you're not getting any interest, of course, for that. So if you can figure out, figuring out what is the sort of the sweet spot of what you should withhold from your tax from your income. So whether you're working and that's through your payroll department at work, or if you're retired and holding a certain percentage from your IRA or Social Security, you can make adjustments on those. So finding where that is, so you're not getting that hero huge tax refund come tax time. The other one that some of you are probably very familiar with is what they call safe harbor. Another word for this is quarterlies. So if you have investment or other income of substance that does not include tax withholding, that you can't withhold taxes for, you may or you should set up quarterly tax payments. If you don't, there can be some penalties that are associated with that. Most of you probably, a lot of people start doing this after they've been penalized one year and they start making those safe harbor or those quarterly tax payments. But something just to make sure that you're effectively managing those as well. Finally, here wrapping up, talking about Social Security taxes. And this is really on the income. And where this comes out, these are payroll taxes. So when you're earning income, the first 142, almost $43,000, and this is 2021 numbers, you do have to pay a percentage of, and these are called FICA taxes. These come through your payroll system. And this tax is basically to cover your future retirement benefits. When you get Social Security, that's because, in retirement, that's because you've been obviously paying in over time. You pay in, the employee pays 6.2%, so does the employer. And if you're self-employed, luckily you pay both the employee and the employer rates, and you pay the full 12.4% component. So this can be a big chunk, 6% of your payroll for earned income. That can take a chunk out of it. The maximum tax payable, that's basically 6.2% of the $143,000 number that's up there. Again, this is current tax law. There's some thoughts on the table that this might change in the near future, and maybe that limit will either go away or will go significantly up, but that's current tax law. The other one in terms of FICA taxes, just to be aware of, is the Medicare portion of the FICA taxes, and that is 1.45%. So again, if you're the employee, you pay 1.45%, and that's on all income. There's no limitations on that. So that's 1.45 across the board, no matter how little or how much you earn. Self-employed also pays, again, the full ride there. I also worked in theirs where that additional 0.9% of additional Affordable Care Act surcharge comes at those limits, something we've already talked about there. And then moving along, and this is the last portion here before we change direction here a little bit today, is talking about the Social Security benefits. So this is on the back end when you're actually taking Social Security in retirement. And not everybody's always often aware that you actually have to pay taxes on the benefits you receive. You always think that, geez, I'm paying into the system, that taxes, that 6.2% that we talked through. So why do I have to pay taxes on the back end? Well, you got to pay taxes on the back end. There's something called provisional income. You can see what that entails down here. We're not going to talk through it right now. But if your provisional income is certain limits, and if you're joint or single filer, then this determines of what your Social Security benefits are taxed. So if you're taking, and this is not just the Social Security amount, these are your total income, provisional income, which is AGI, as you can see here, non-include Social Security, plus tax exempt, plus 50% of your Social Security. So this is just not, these numbers here are not what you're getting from Social Security. This is your total income, meaning, your AGI plus from there. So most people, it's tough to survive, have tax return with less than this in retirement. So very, very few people are taxed at that 0% rate on Social Security. More often, most people are taxed at 85%, up to 85% rate. So if your joint taxes are over $44,000 for that provisional income, you're paying 85% of your Social Security benefit is taxable. So I know this gets a little complicated. If you have questions, let me know on that one. There's some information in the book as well that's out there. So with all that being said and done there, we're going to, again, transition to the planned giving portion of tonight's conversation. So in a moment, I'm going to disappear until the end, and I'll come back, and then David's going to magically appear here in the screen momentarily. So this is, David lives and breathes this plan giving space. He's fantastic at what he does. He's the director of plan giving at Masonic Village in Elizabethtown. So his full bio is at the beginning of the booklet, and certainly greatly look forward to it. So I think David is making an appearance, and he's going to share his screen here, and we'll see you later on at the end. Thank you.
Tracy, will you confirm my screen here? I have a couple screens going that I'm sharing the blank.
Well, right now it's a blank screen, David, but it looks like it's a
that's
PowerPoint.
great. Well, good.
There we go.
All righty.
Excellent. So go ahead, and we'll see you at the end.
Okay. All righty. Well, there are three things we can do with our money. We can save it, we can spend it, and we can give it. And sometimes there's a fourth thing. Maybe some of you are of the age as I am that you can remember Spanky and my gang. And there we see that we can also throw it out the window or lose our money. But today, I'd like to visit specifically with you about that third thing that I mentioned, and that is giving our money. Tonight, before we begin, I think it's important to reflect why would we even think about giving our money? In the context of putting our financial house in order, what is the point of giving money at all? And we're talking about that tonight really for a very specific reason. And that is there are opportunities when we give our money. In some instances, we can give our money in a way that will proclaim God's word. Sometimes giving money is a means by which we can share God's love. Sometimes there are instances when giving money means it is a way that we can practice God's justice. And so that's why we're going to talk about giving our money today, is because it can be ways to fulfill our personal missions, the missions that are similar to that as members of Dairy. Now, my professional work is all about giving, and I like to recall that no matter when I talk to people, like so many other topics, the topic of giving is often an emotional decision. In some instances, people have tell me that they have analytical kinds of needs to analyze and think about how they want to give their money. But essentially, time and time again, I realize it's essentially an emotional decision. So I really, with that in mind, think that probably it's safe to say it's good to start with simply thinking about what brings you joy. And that's probably a good way just to start our thinking about giving money. It's primarily in those instances where our giving is challenged by others that we find some kind of rationale is necessary. And of course, definitely spouses who share money need to come to an understanding about their giving through intentional reflection and conversation. But tonight, we'll begin by looking at simply what to consider when making your giving decisions. When planning your giving, start with the personal reflection. Who do you love and what do you care about? What past gifts, I also ask this question, what past gifts are most remembered by you? And what past gifts have brought you most joy? Another place to start is to reflect upon your experience as the recipient of gifts. Have you experienced joy or delight or maybe relief as a recipient of a gift? And so that, I think that question might be one that we could poll. Tracy has a polling question I'd like you to look at for a moment. Now, thinking now as a recipient of gift, which of you, and you can choose as many as you like here, there's 4 possibilities. Which of you maybe have been a recipient of food or housing? Maybe how many of you have received a scholarship to attend school. You can pick as many as you like. Maybe how many of you have received an inheritance from an estate? Or maybe you've received help with a financial emergency, or maybe the purchase of a home or an auto.
We'll go ahead and bring up the results here in a moment. It looks like some folks are still contemplating, but we're getting more results. So in a couple of seconds, we'll close out the poll.
Okay, thank you. Okay, so here we see the results. There's really people in all categories. 8% have received at some point in their life assistance with food or housing. Scholarships, 73%. 50% have received an inheritance from an estate. Another 50% have received a gift or for a financial emergency, maybe a home purchase or an automobile purchase. So I think this is one of the first things I invite individuals to think about is your experience as a recipient and how that experience went for you. Thanks so much, Tracy, for running that poll. So let's go to the next slide here. So let's think about some specific considerations when contemplating a gift. And probably the most important consideration is to start with the need of the potential recipient. That's where most of the analysis often starts. The first and most basic question may be pretty simple, and that is what it is that the person is asking for. A need is often articulated through a simple ask, such as, I need a specific dollar amount for specific needs. At one end of the spectrum, maybe you've experienced a situation where someone says, I need $2 for bus fare to get me home. Or at the other end of the spectrum, maybe you've had that phone call from a child that says, hey, Dad, I need $5,000 for the final semester of college fees. We can consider that also the collective needs of a larger group served through organizations. For example, a college might send you a letter saying, we have this collective need of scholarships for all of our students. In that case, we are contemplating what I might consider to give to those who I may not even know. We can also include in our giving analysis a consideration of the impact of a gift that a particular gift might have on different recipients with similar needs. For example, let's say that I'd like to make a $5,000 gift in a year to help an elementary school student at Joan of Arc. That would pay for one student. Our local school here in Hershey, $5,000 would pay for 1 year of school there. Interestingly, that same $5,000 given through the Presbyterian Education Board in Pakistan would cover the same need for 13 students. So a general rule of thumb that you may want to keep in mind is that, generally speaking, a dollar given outside of the U.S. will go much farther. Consideration should also be made, I think, when planning to make gifts to young persons and individuals with compromised decision-making abilities. You should probably think about, does the recipient have the ability to manage money? Are they a spendthrift? I think you should also seek professional advice, especially regarding best strategies for recurring gifts or estate gifts intended for special groups of people like students or individuals who may be intellectually or emotionally challenged, individuals with addictions are concerned, individuals with legal convictions, individuals with current or potential bankruptcies, divorced individuals or persons at risk of divorce. These are all categories that you should give special consideration to in addition to the needs of those individuals. The next slide here says the consideration should also be made when planning to make gifts intended to help persons who may currently be receiving Medicaid, or whether other sources of income are available. I know that I work with a lot of families that might have a family member that's receiving Medicaid for their long-term care. And in those instances, a gift in many ways is actually counterproductive. A strategy that may be considered to address many of these groups I've just mentioned may be to explore the option of giving a stream of income versus a lump sum. In some cases, estate giving streams of income can also offer the advantage of reduced income taxation. Let's see here. The other thing that I like to point out is that just as we need to make spending decisions based upon needs versus wants, when we find that we want to give more than we have, we may need to consider prioritizing and making an annual budget for giving. A budget for giving might include categories, categories such as family or friends, categories of helping strangers or society in general by gifting through organizations. Subcategories might be things such as health or human services or education. Also, sometimes it might be interesting to make a budget based upon a mission statement. You might, for example, budget X dollars for sharing God's love, Y dollars for practicing God's justice, or Z dollars for proclaiming God's word. And I also find it helpful to have a budget category for giving for to be determined, something that would take care of unforeseen needs, things that we do not know that may happen on the horizon, gifting opportunities that arise each year that we had no way of anticipating. All right. The next slide here says that it would be good to also consider when to make the gift. Remember that once you've decided how much you'd like to give and to whom you would like to give, or for what you'd like to give, there are also options regarding when to give. This slide says give now, give later, and some charitable organizations also offer strategies where you can include or have elements of receiving now and giving later. So all of these are options that might be considered. Once you've thought through that, the next question is, which type of assets would it be best to give? And Tracy's touched upon this a little bit. Other than your checkbook, we often are aware and think about that. But it's important to also consider other options such as appreciated investments. For example, a stock that was purchased at a smaller price than it's worth today can be transferred directly to charity without any capital taxes due. Another one that I would like to offer a little more detail, Tracy touched upon, would be gifts from IRAs or qualified type accounts. Real property or tangible assets, that's another option. Insurance products with cash values include annuities and life insurance. There are several things that should be considered in addition to simply the checkbook. Let's look, Tracy mentioned this though, think more deeply about this idea of giving from your IRA. What I see is a traditional 70-and-a-half-year-old, when you pull that money, you make your IRA withdrawal, income taxes is needed to be paid and often is done by means of a withholding. When that happens, some of your withdrawal goes to the IRS, the balance comes to you for your checkbook. And then traditionally, we then have the money there in the checkbook from which we might make our giving. If in this example, $1,000 was withdrawn, 150 went for withholding, we have $850 now to make gifts. Interestingly, because of what Tracy just showed us about those standard deductions of, say, $25,000 for a married couple, in many instances, many people are not even hitting that $25,000 threshold, and so their gifts are not actually being deductible because of that higher threshold. A better option can be to ask your IRA company to make direct distributions to the charity support. When you do that, you avoid the declaration of that as income, as taxable income. You can do that up to $100,000 per year. This is very popular, particularly with individuals who are at the point where they have to make required minimum distributions. Those of you who have not yet started your required minimum distributions, that age now has been pushed off to age 72. But when that happens, if you do not need the money, this is a very nice way to make charitable gifts, is through those direct distributions right from the IRA. Let me shift gears a little bit with this next slide. Let's think a little bit about not just giving in general, but the kind of giving that is that everyone must make, and that's the gift that will be made upon your death, the balance of everything that you've accumulated throughout your life. I'd like to remind people when it comes to plan giving that there are some things that are obvious but often are forgotten. First of all, everything you have will actually be given away or taxed away. And you do have countless options regarding how your estate will be distributed. It's not simply a single size fits all. I like to remind people that you don't actually know when you will die. These plans have to be in place with the possibility that it could happen today, rather than assuming you know it won't happen today. And then the other thing that I like to point out is that intentionally planning your estate giving is going to be a continual process, one that will change throughout your life. What you have will change from year to year, what you have to give in your estate, as well as the needs of those that you love and those things you care about, they also change. And so that's something to keep in mind. It seems very obvious, but it puts for many people, a new perspective about their giving. So if intentional giving through your plans, through your estate plans is a continual process, I then ask, what form does that process take? And how might we approach making the decisions about the estate gifts that we made to those we love and to what we care about? And I'd like to introduce this slide today, which is an easy to remember process that I call the 3 R's, which are reflect, review, and revise. First of all, we reflect upon who we love and what we care about. We review our current estate values each beneficiary will receive, and then we revise when necessary documents to reflect the current wishes. And then from year to year, we simply repeat. What I'd like to do is look more carefully at each of these 3 R's. Let's start with the first one, which I simply call reflect. This is really about reflecting about who you love and what you care about. And when I say that, I encourage you not to forget about all of your relationships, children, grandchildren, nieces, nephews, cousins, aunts, uncles, siblings, parents, those who are adopted or related through marriage. Who are your friends? What joy would a gift to each of those bring to you? And what are the needs of each? Would a gift of money address their needs, or would their needs be met better by some other means? These are the kinds of things that begin that reflection process. And then after that, the next step would be to reflect about how, just as we consider when making a gift, reflect upon the needs of the persons you love and those served through the organizations you enjoy supporting. So to what extent could those needs be met with an estate gift? What would be the consequence of a gift? Would it mean that someone could retire earlier or stay home with their children? Is that what they need? Would a gift mean that someone could afford the personal care that they would need in their final years? Would a gift through an organization serve the needs of someone you have never met? And how might the community or society as a whole be served with your estate gifts? Part of reflection then also includes, given the needs and the impact that an estate gift might have, you begin the process of prioritizing. You may want to think about it as an estate budget based upon the current situation. I sometimes ask individuals, To whom and to what organizations have you made gifts this year? Did you make gifts to children? Did you give equal amounts to each child? Will you typically make gifts to other family members or friends? And maybe to reflect upon what's the ratio of your current giving between each individual and organization. And I ask people often to consider, could those same ratios of current giving inform your estate giving? Sometimes everything is sold at auction in estates and then distributed as cash. But sometimes estate giving includes specific real or tangible items that might align better with a particular recipient versus another. This might be something small that you can hold in your hand, or it might be something as big as a homestead. But there are some things that you should reflect and consider, would this particular item be best given to this particular cause or to this particular person? And most importantly, when we think about specific gifts or specific assets to specific persons, I think it's good to keep a rule of thumb in mind, and that is to gift dollars from the accounts with the highest tax liabilities to not-for-profit or tax-free organizations. This would be things like your IRA type retirement accounts that carry both income taxes and state inheritance tax liabilities to any humans that might receive them. But those same items given to charities have a 0% tax consequence, a 0% inheritance tax, 0% income tax. And then the corollary to this is to give dollars from accounts with very small tax liabilities to the humans. In PA, that would be, for example, life insurance, which is inheritance tax-free and also income tax-free. So that's part of the challenge of this plan, is to reflect which things to give to which parties. And then the when of estate gifts, that should also be considered. This can be particularly important for couples. Sometimes couples may thoughtlessly default to leaving everything to one another, but consideration should be given regarding when an ultimate gift should be made to maybe the school or the church or the charity that is dear to one spouse, but not to the other. And then there is also the matter of when to make gifts to children from former marriages. Of course, if gifts are given when the first spouse dies, couples need to reflect if there will be enough left for the widow. This is an example where maybe whole life insurance is needed to make up and to fill that gap if gifts are given upon the first spouse to die. If there are spendthrift recipients or younger gift recipients or high income recipients nearing retirement, maybe those recipients would benefit from having gifts distributed over a longer period of time, and maybe small lump sums, or alternatively as a stream of income for a period of time in their life. That's something to think about in terms of when as well. And this brings us to the second R of the 3 R's, and that is to review. Because what you have is constantly changing, and because the needs of those you love and what you care about are also changing, I'd recommend that you periodically put a pencil to it. What would everyone receive if you were to die today? And this would include things such as reviewing the bequests outlined in your current will or trust documents, reviewing the beneficiaries designated in life insurance, pensions, tax qualified accounts or annuities, reviewing account ownership and transfer on death registrations. Other things to be reviewed are the current value, of course, of your accounts, current debt, life insurance death benefits, real property values and entitling. And then it's also helpful to review and be aware of the various inheritance tax rates and income tax rates for each of your proposed beneficiaries. Here's a sample document that I would prepare, a sample of what this would look like to review what your current plan looks like. And on this spreadsheet here, we see 5 different boxes, and they're categories based upon how the assets are controlled and whether or not they are taxed or how they're taxed. The first top left box there has things such as your personal household items, automobiles, checking account, investments, your residence, and so forth. Those are all passed by your will, and they pass free of income tax or capital gains. The next box below that has items Roth IRAs. Now they pass by beneficiary designations, or on this list I might also have items in a living trust, but those items pass in documents outside of your will, free of income tax or capital gains. The top right box, I have another category, again, passing outside the will through beneficiary paperwork. Those items that are fully taxable to human beneficiaries, and there I've included IRAs. The next box on the right side has some things, again, that pass by beneficiary paperwork. Only the investment gain is actually taxable. And then the bottom right box are the things that pass, again, by beneficiary paperwork, no income tax. And this is the only item on the whole page that would pass without inheritance, Pennsylvania inheritance tax to beneficiaries. I'd like to bring your attention to the very bottom there. It's interesting in this particular case, and I see this time and time again, only about a third may be actually controlled by the will, and 2/3 is actually being controlled by beneficiary paperwork or account registrations and things such as that. So the next step is taking all we have and then our wills and our beneficiary forms and looking at what each of our beneficiaries might receive. And this might be what it would look like. And we see on the left side here the beneficiary designations for family or friends. We have a daughter, a son, maybe a sister or a nephew listed there. The percent that we've designated for them in our documents, the gross. And then here is where this comes into play, the inheritance tax rates. And we see 4.5% for children, 12 for a sibling, and 15 for this nephew. Income tax rates, those are important for those IRAs that pass. And then we see the net, what they would actually get after the estate is passed. At the bottom, we have beneficiary designations summarized, maybe intended to help others through charitable organizations. In this example, there's maybe a church or a college. Maybe there's a $10,000 gift explicitly listed for a church, or maybe a 1% for a college. And we see that there at the bottom. Once you have done this, then you again pursue this concept of reviewing. Reviewing whether your current estate gifting still aligns with what would bring you joy and the needs of those you love and that for which you care about. And so let's look at that slide one more time and do a little bit of that. On the far right side, you see the amount each person will receive, and then a purpose. And you can ask yourself, all right, originally I wanted to leave to my daughter money to help educate grandchildren. Is that $363,000 still the right number to do that? How old are they now? Are they still in college? Are they going to college? Or are they done with college? Is this now maybe something that they will need, my daughter will need for weddings? You know, just reviewing, is that still the right dollar figure? The gift for the son, Bob, he never had much of a good job, and his retirement's going to fall short. Is that still the number that would make sense to give to Bob? Maybe a sister who's a widow, who's older, and you know that she's going to need help with her own health care. Is that still her situation? Or has she found some other solution? And then the nephew, did he go to school? Is he going to go to school, or is he now working in the warehouse? And at the bottom, we see the purpose and benefit, reflecting, are those the right numbers for those purposes? And would we want our gifts to charities to be anonymous or acknowledged? That's what I call simply reviewing and making sure are things still as they should be. Asking myself, are the right amounts and the right ratios still there, that what makes sense, and what would, and also what would bring me joy? So the final R is R for revise when necessary, and this is necessary when things fall out of alignment. It then becomes necessary to make updates to one or more of the following. Remember the spreadsheet that I showed you earlier? Different types of things are controlled upon death in different ways. only a portion of what you have may be controlled by the will. You also have to keep your current beneficiary paperwork on IRAs and your life insurance and annuity products in order. You may need to revise account registrations that may be joint, or accounts with transfer on death, things such as this. You may even need to revise property titles. So those are the revised steps that come next. Now let's look at a couple examples for fun. The first one here is Mary. Let's look how Mary maybe has used the 3 R's. Mary's a widow, maybe age 80. She's a lifelong church member and maybe a food bank volunteer. She has a married son, age 55. And her son and daughter-in-law are secure in their ability to care for themselves and their children. Mary receives Social Security and a pension, and she's seeking a simple and predictable, secure alternative to the dividend income she receives from her stock portfolio. She also tells us that she'd like and would enjoy making an estate gift along the way too. So she has a total estate. She has a home, an IRA. She has a stock portfolio that's paying dividends. It's highly appreciated. If Mary sells and reinvests her stock portfolio for an alternative investment, her accountant estimates she might owe a capital gains tax of $7,500. So here's a possible solution. Mary decides to gift 50,000 of her most appreciated stocks directly to her community foundation. And based upon her age, Mary receives a charitable gift annuity that pays a fixed payment of 6.5% for the rest of her life. The dividends from the stock were 2%. Now she's enjoying 6.5%. And then upon her death, a charitable gift will be given to her church and to the food bank. Here's a summary of the benefits: a simple and predictable annual income for Mary, a higher rate of earnings than from the dividends, and a portion of her new income is also tax-free. She'll receive a charitable receipt because she gave the stock directly to the foundation. There's no capital gain declared. Now her son's inheritance is smaller, and Mary will not be able to get her money back, but estate gifts will be given to her church and to the food bank. Let's look at one more example here. Bill and Jane, a married couple, age 75, both retired. They enjoy making gifts and volunteering at their church, the Rotary Club, Penn State. They have 2 adult children who are also married and 6 grandchildren. They interestingly have a concern that if they both die today, a large IRA inheritance would be left to their children, and a large inheritance that would be highly taxed to their professional children. They have $1.5 million in the IRAs, $500,000 in their house, and $200,000 in other investments. So this is what they might consider doing. They write a new will that directs the non-IRA portion of their estate to their children. The house, the other investments would not have income tax due. There is inheritance tax, but no income tax. And then with the IRAs, they decided to create what I call here a give it twice income trust. The IRA inheritance goes, instead of to the children directly, it goes into this trust where income is then spread over 20 years and keeps the children in a lower tax bracket. And then after 20 years, the trust is closed and the remaining balance is given to their favorite charities. This is another popular strategy I'm seeing with people with large IRAs. The income coming out, say, for a period of years or even for the life of the children. The benefit, the children may stay in a lower income tax bracket, and there are really 2 gifts instead of 1. The children receive their inheritance in the form of this payment, say 5% from a $1.5 million trust. That would yield a total of $75,000 split between 2 children would be $37,000 each for each year. And then after their death or 20 years later, whichever is chosen, a second gift actually is made to their favorite charities of an amount similar to the current beginning balance of $1.5 million. So those are 2, I think, good examples of people who have done this. I think before I close, one final note on charitable estate planning would be to touch upon the resources and the persons that could support you through this 3R process. And let's look together at this planning table. You, of course, is on the right side. Your job is to desire and discern the best possible outcomes for those you love and for what you care about. And on the bottom, you see the attorneys, the investment and tax professionals. But on the left side, there's a chair that may not sound familiar, labeled charitable gift planner. The work of the charitable gift planner is to provide a structured planning process and to illustrate various charitable estate gift options. Those kinds of people can be found in the development offices of most major not-for-profit institutions or in your community foundations. There are community foundations based in the various counties. The Foundation for Enhancing Communities is here in Dauphin County. Similar things in Lancaster and York County. Pam and I use a national community foundation called In Faith. The Presbyterian Church also has its own foundation that has professionals that do this kind of work. And I'm also available as a volunteer to offer confidential estate gift planning consultation to any members who might be interested. So in summary, I like to remind everyone that essentially this giving is, in its essence, it's an emotional decision, but there are nonetheless some things that should be taken into consideration, and there is a structured process that can help you make those decisions that will bring you joy and bring the best possible outcomes to those you love and those things you care about the most. So Tracy, thanks so much. I'm going to unshare my screen, and I'm going to turn off my video. And Tracy, if you're there, we're ready for you to take it back.
Yeah, thank you so much, David. Greatly appreciate all the expertise and everything you just shared there. Lots of great things that, to reflect, review, and revise. There are a lot of good things there. So I think you left the group with a lot of great questions to think about. And, I would also point out that a lot of what David walked through, there's not always, it's not black and white. There's a lot of gray areas to get to that same end result. Many ways to get there, and that's sort of been a theme, I think, of these sessions so far. That there's, whether it's with investments or retirement planning or however you're getting to where you want to go, there's not a right or wrong way to get there, and there's multiple ways to get that same result. So, again, thank you, David. Super informative. If anybody has any questions for David, I know I didn't mention earlier, as I often have done, but the chat feature at the bottom, if you have any questions, go ahead and type those in. We do have a few minutes here. We can handle some questions, but go ahead and put those in there. David's contact information is in the booklet, in the outline of all the, and virtually everything that was on the slides except the pictures were captured in that booklet, so you can certainly review those type of things. David's contact information is also in there as well, so don't be afraid to reach out and contact him. So we're going to transition again, and it seems I'm not sure how to make it a smooth transition at all, but a quick chat on identity theft, because this is pretty important and becoming a bigger item as time goes along in the financial world. And of course, if you're a victim of identity theft, then my guess is that in some way, shape, or form, probably everybody on this call tonight has been to some extent. But again, it can give a lot of major headaches and ways to get out of it. One of my clients just contacted me, I think, a week ago, and said their identity was exposed, and it's tough to recover from there. So a couple statistics that are in the booklet and on the slideshow beforehand that you might have noticed. Every 3 seconds there's a new victim, which is the fastest growing crime in the U.S., continues to be the fastest growing crime. And in 2019, the last full year of data points that are out there, there were over 14 million victims of identity theft, really new victims from that year. That does not include stolen credit card numbers. That's outside of that. So that's about 1 out of every 15 people there. So pretty dramatic number that's there. So, again, hopefully this is mostly common sense, but I found that sometimes it's good to just to review some of the best tips. But again, some reminders that you probably already know. never ever share social security numbers. There's a lot of scammers, especially over the phone or intranet. There's lots of times where they're asking for to type in that stuff. Unless you know exactly where, who you're giving it to and the reason it's needed, don't give that information out. Password protection on computers, smartphones are important. Complex passwords are best to use. Cameras, skimmers, or other devices that, whether it's at the ATM, gas pumps, anything of those natures, just be aware of all those type of things. Hopefully everybody has a shredder, shredding sensitive personal data. Just don't put it in the recycle bin. There's thieves that go through recycling bins and all those type of things. Clicking on unknown emails or links, especially within those unknown emails, is something that catches a lot of people. I know at my office, our IT staff runs monthly campaigns, sort of phishing campaigns, to try to test our employees of who they can catch, and there's always people that fall for certain ones, and people can pretend that they're somebody else, and you think that somebody that is sending an email and it says click here. Probably all of us have gotten that email from some long lost relative or friend that's vacationing in Europe, and they run out of money and they need you to send you money by clicking on here and providing some type of funds for them to get home. Of course, all those things are scams. They're getting pretty sophisticated in that way. A couple things that you can do. Checking your annual credit reports is a great thing to do, and that's the website annualcreditreport.com. Would encourage you to do that. There's 3 credit agencies and bureaus. You can check those for free once a year at each of those 3 bureaus. All this information again is in the booklet. There's also a phone number in there in case you want to call. Pre-screened credit cards, sometimes that's sent out, and if a thief gets a hold of it and they have some of your information, they can do some of that, some damage that way. So you can opt out of pre-approved credit card applications that come through that opt-out pre-screen. That's what that one is. The DMA choice, that's a junk mailing list. You can get off of that list by going to that website and registering. Do not call.gov, that's probably one you're familiar with. That's the National Do Not Call Registry. And then, identity theft monitoring services, you can pay for those. LifeLock, Identity Guard. It's not an endorsement for either one, but there's some other ones that are out there as well as you go through. So again, lots of things to think about and talk about. Next week, I'm going to kick us off and close, but the majority of next week will be the man, the legend, George Porter, talking about what we need to do with estate planning. So this is absolutely critical. So please be sure to tune in next week. That'll be the last of the 5 sessions. Lots of great things. If you don't know George, he's tremendous. So he'll be able to impart a lot of great wisdom for us from that standpoint. So I'm not seeing any poll question or any chat questions as we see right now. So, again, for tonight, a big thank you to David for spending that time with us this evening. Plan Giving, clearly, that's his bread and butter. So please do reach out to him. He mentioned, as a volunteer, he's happy to answer any questions you might have. As mentioned, his email address is in the booklet, as well as his phone number he was kind enough to share. David's been part of Stewardship and Finance in recent years at Dairy, has helped with several initiatives. So as mentioned, he does those complimentary consultations to Dairy members to explore options, for giving, and helping with your plan giving. So I would encourage you to take advantage of that opportunity and do reach out to David. So again, David, thanks so much for your valuable insights and expertise this evening. And everybody else, thanks again for tuning in for week 4. I saw through the chat feature, some people were saying great music with the polka music. I understand some people love polka music. Some people might not like polka music. Next week, no polka music. I have something teed up for the grand finale there. But hopefully everybody has a great week, and we hope you've been enjoying these sessions, and we look forward to seeing you next week for the grand finale. So again, thanks for everything, and have a great evening.